Hello guys, it's Chris from TheTradingExchange.co.uk, and we're going to take a look at the first video in our series of training videos, and this one is going to be taking a look at moving averages. Okay, so this video is aimed for anybody who's looking to get themselves started with trading, get into some profitable situations and start really making a bit of an effect on their account. It's aimed at people who are spread betting or CFD trading in either Forex, indices or commodities. And there's an assumption that there's a little bit of an understanding of the basic fundamentals of trading. So you understand what a pip is, what a candlestick chart looks like. You've installed a basic trading platform already, and you're pretty much ready to get going. Okay, that being said, we're talking about trading on margin here, and so that's going to carry quite a significant risk. Trading financial markets is risky. It involves the risk of losing all of our invested money. We don't provide advice here. The website really is designed for educational purposes, so please use the information at your own risk. Okay. So moving averages, that's the first one we're going to take a look at. Now this one's important because moving averages are used by pretty much all traders of all abilities. They're used by electronic trading systems, algorithms, fund managers. They're used by the media, retail traders. Everybody really uses in some form a moving average. So we're going to take a look at what they are, how they're used, the different types of settings you can have, and some strategies as well that you can utilize in your trading that might be able to help you make some really profitable trades. Okay, so first things first then, before you start trading or finding any trading opportunities, you should also always follow some basic guidelines. So I'd recommend you identify the direction of the trend that the market is going in, and always stick to that. So simple fact is, draw a trend line. Whatever you might want to do, you can just do it visually if you wish, but understand the trend of the market that you're trading. Is it going up or is it going down? So is it bullish or bearish? If you can't see it visually on the chart just by looking at it, then a moving average is going to simplify that process for you. It's probably one of the most important guidelines that are most commonly neglected by traders. So I'm going to just hammer that point home. Don't ignore the simple guideline because it will really help you trade. It's like running. You know, if you're running into a wind, you're going to have to work a lot harder to get to your goal. If you're running with the wind on your back, then you're going to get there much faster. It's the same with trading. If you're trading in the direction of the trend, you're more often going to get to your goal a lot faster than if you're trading against it. Okay, so that bit's over and done with. Let's take a look at moving averages then. So what is a moving average? Well, I mean, in its simplest form, it's a basic calculation that sums up all of the closing prices of your data, and it divides them by the number of price points that you want to look at. So when you select a moving average for your chart, they'll ask you for a number. They'll ask you for the number of periods that you want it to look at. There's an example on this chart in front of us here. It's an hourly chart of the German DAX. There's a moving average line just here, and you can barely see, but it's a 100 period moving average. So that has taken all the closing prices of the last 100 candles and divided them by 100. And every time a new candle closes, it then takes that piece of data into the average and removes the very first one. And it just continually updates, and it graphically represents that data in a smooth line. So in its simplest form, yeah, it's the average closing price of a currency pair or a market, whatever you're looking to trade, over a specified period of time that you choose. And on a daily chart, which is what we're going to take a look at now, it's normally the first step I tend to go for. I would normally use a 200 period moving average. Just a simple 200 period moving average. Let's make it black just so it can be seen. If you do hear some noises as I'm talking, it's because I've got a signal generator that's providing signals. I'm ignoring them for the moment, and if I'd have thought about it, I should have turned them off. Okay, so there's quite a few lines on this chart. I am actually going to tidy it up. Okay, here we go. There we go, 200-day moving average right there. So in this particular case, it's taken the last 200 days of data and averaged it every day. Now, a moving average is going to update constantly. Okay, it's in a constant state of change. The oldest data point will be removed every time a new one is available. And there are two types of moving average. You've got the simple moving average, which is this one, which is very, very basic. And then there is an exponential moving average, which is also very, very popular. And the exponential moving average is a lot more complicated to calculate, but in essence what it does is it just applies a weighting to the most recent data instead. So it doesn't make it nice and even over the 200 pieces of data. It will kind of apply a higher weighting to the most recent and a lower rating to the oldest stuff. It's a complicated calculation, but fortunately most charting packages will do it all for you. And I don't know what charting package you're personally using. It might be the FXC and MarketScope like I have here, or it might be MetaTrader like this, or it might be NinjaTrader or whatever else it is that you use. You'll often find that they're going to include the moving average package automatically for you for free. Okay, so moving averages are typically used to get a clear view of the overall trend of the market. So in trading, the moving average, as we know, is the average of the closing prices. You can often see the trend of the market just by looking at the price action, and you can tell whether you're in an uptrend or a downtrend in this particular case. But occasionally with volatility, price action reacts in ways that can blur the trend. It can sometimes be difficult to see. So moving average will just help you smooth out all of that choppiness and just decide, are we bullish or are we bearish? And it makes the decision very, very simple. So in this particular case, we've got the 200 period moving average. And it's the most common one. The media use this. You'll often hear it referred to in, online blogs and Twitter and all this sort of stuff, and in the press. Some of the biggest traders in the world are looking at that on their charts. And so it's a really, really common benchmark indicator. So how do you use it? Well, you place it on a daily chart, and then you just see where price is in relation to it. So in this particular case, price is trading below the 200-day moving average. So therefore it's bearish. We're underneath. If it was above the 200-day moving average, like here, it was bullish. And in its simplest form, if you wanted to keep things very, very basic, as soon as price crosses above the 200-day moving average, you can go long. As soon as it crosses below, you can go short. Sometimes it will work, sometimes it won't, but that's trading. So in this example here, I say this example because it just was the first place I clicked. You would wait for a candle to close above the average, and once it does, you will go long. It's a very crude, very basic strategy, and sometimes it will work, sometimes it won't. But in this particular example, I'm just going to zoom in on that. In this particular example, imagine that this wasn't, this data was as it was when we were looking at it on the chart. That would have been the candle to signal that we were going to go long. We had a close, so on that candle here, we would have gone long. We would have placed a protective stop under the most recent low, which would have been there. And then we would have entered the trade. In this particular case, it would have worked out quite nicely. And we would just continue to move it and go and go and go. I mean, in an ideal world, that would be great because that's 1,500 pips or points. But that gives you an idea of how you might use it. And you kind of think, well, when do I get out of the trade? Well, you'd get out of the trade as soon as price crosses it again to the downside. So you would have actually got in here. I think you'd have got in there. And you'd get out about there. Assuming that this was how it worked. Okay, in reality, it might not have been like that. It might have actually happened there. But we'll ignore that for now. So in this particular example, you've actually not risked a great deal. You've risked, 200 points, and you've gained yourself 1,300. Happy days. You've just got yourself 6.5 to 1 risk to reward, and £1 a point, 1,300 quid. Not too bad, or $1,300, or 1,300 euros, whatever. It's taken quite a while to get there. In fact, it's taken 152 trading days, half the year. So you might think, well, what's the point? I don't really want to trade for that. But still, you've just gained yourself quite a decent amount on a very, very basic strategy. And it would work again on for this particular example here. Once you've crossed below the 200-day moving average, so that particular candle right there, you'd go short on the next candle, which would be there. You'd place your protective stop above the most recent swing, which in this case is quite a lot up there. I mean, you might want to perhaps move it just to there instead. And then you would leave the trade going. And you would say to yourself, right, I'm just going to leave it until the price crosses the moving average again. And in this particular case, you would have been up quite nicely by sort of 1,500 points. If you'd have sat on that, then you'd have been quite pleased with yourself, I'm sure. But price actually then did come back and reverse and would have stopped us out because it would have crossed the moving average once more and we would have closed the trade. Okay, so it's not always going to win, but it gave you another opportunity when it came back down here. And right now you'd still be in that trade, so you would have got in there. Put your protective stop loss up here above this little high. And then just ridden this all the way down, or rode this down. Okay, so I've laboured a little bit on that point, but it gives you an idea of how you would use the moving average to decide whether or not you're bearish or bullish. If you're above it, you're bullish. If you're below it, you're bearish. Simple as that. So once you've established the trend, providing you don't want to use that particular strategy that I've just talked through, it's very basic. But once you've established the trend, you can then scale down into a lower time frame. And you can use a moving average to pick the entrance and the exits. But a single moving average on its own, a single line, only really tells half the story. So a lot of traders will often use a combination of moving averages to help them time a trade properly. And to do this, they'll follow a slightly more advanced strategy, which is what we're going to take a look at for you now. And the strategy we're going to take a look at is a moving average cross. Okay, so this is where you use more than one average and you're looking for averages to cross over themselves to give you a better indication of what the market has been doing. So let's go and take a look at the 30-minute time frame. We've decided that we're bearish because we're below the 200-day moving average. So with that information in mind, we go to the 30-minute chart. Now I've changed my time frame to the 30 minutes, which means this moving average here is now no longer the 200-day moving average. It's the 230-minute moving average, if that makes sense. So it's 200 30-minute candles that have been included in this, not daily candles anymore. Okay. So once the trader's identified the trend, they'll scale down to a lower time frame, which is what we've done now. 30-minute time frame we're on right now. I mean, you could scale down to the 5-minute or the 15-minute. It's up to you. 30-minute is just one I tend to use myself. And from here, they're going to apply a moving average cross system. Okay, so it's going to involve using I'm going to use two more moving averages on this chart. And the two moving averages are going to perform different roles. One moving average is going to be really slow. Not quite as slow as 200 days, but slow relative to the second one, which is going to be a lot faster. So this will mean that the moving averages will smooth out the price at different rates. So I'm going to apply a 50 period and a 20 period moving average. Okay, I'm going to apply exponential moving averages this time and not simple moving averages. Just that's my preference. So let's apply a 50. Let's make that, I don't know, green. And let's apply another exponential moving average. 20. Oh, can't type. 20. And let's make that blue. Okay. Gets a little bit congested with all the different moving averages, and I personally don't like to have too much on my chart at any one time. I find it can make things a bit cluttered. But it shows you now two different averages that you've got. So, how are we going to use that information? Well, the easiest way to do it, and I'm just going to remove this 200 period average here because it's the daily one I was really only interested in. So I'm looking for periods where the faster moving average, which is the 20 periods, I'm looking for times where the faster moving average is closing or crossing below the slower moving average, which in this case is the 50, the green line. So every time the blue line crosses below the green line, that gives us a signal to sell. And I only want selling signals because we're in a bearish market. As we looked at on the daily chart, where we had the 200-day period moving average, we're trading below that. We're only looking to sell. Don't want to buy. So we're looking for periods where this blue line crossed below the green line. And there were a couple of times that happened. And here we go. So there was one here. Kind of another one there. Another one here. One there. One up there. So visually you can see a few of them. There was nearly one there, but it didn't quite get there. One here. So you'll notice that the blue line crossed above here, but we're not looking to buy. We're in a bearish market. So we're not trading the opposite direction of the trend. We're just following the trend only. So we could have got in. Let's just try and highlight some of these. There. Or there. 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 There's actually another one there. And that's it. So there's a couple of opportunities to get in. There's probably another one up here. Yep. Up there as well. So if you'd got into some of these trades, you'd have done quite well. Some of them may not have won. You might have lost out on a couple of them. So let's just take a look at a couple of these as an example of what you might do with your entries and your exits for how to actually trade them. So let's go and take a look at this one first. Okay, so it crossed there. So what you would do is you would say to yourself, right, well, as soon as I have had my candle close and the line has crossed and it's confirmed that it's crossed, I'm going to enter the trade. Okay, so let's just say that we got in about there, wherever it might be. Okay. You look back to the most recent swing high, which would have been there. And that's where you'd set your protective stop loss, because if it goes again higher than this and it turns in the opposite direction, you want to get out of that trade. So you got in there. You said to yourself, right, I know how much I'm risking now. I'm risking 155 points, quite a lot in this particular example, but let's go with it. And let's say it's $1 a trade, $1 a point, or £1 a point, or €1 a point. You know, 13k lot, or whatever it might be that you're doing. You're going to try and go for double that to make it worth your while. So you might have to sit on the trade for a little while, but that's what you're going to aim for. You're going to set the limits, set your protective stop so you know how much you're risking, and then you want to go for 300 points in return. 310, let's say. So that's going to be about 10.4, around about there. And in this particular case, it works out quite nicely. Had you have got in at that point, you would have made the trade and made you 310 points, no problem. Looks pretty simple, right? Show another example. I'll zoom out a little bit more. Let's go and have a look at this one here. Okay, same sort of thing here. As soon as the price closes and you're happy, let's say you got in there on this candle around there, you set your protective stop up there. You say to yourself, okay, I'm shorting the market. I'm risking 280 points, probably a bad example. I want to go for 560 points profit. Otherwise, I'm getting out of there. Could be quite a nice trade if you get it. 560 points is going to be about 9.3. Way down there. So you just leave that trade on. In the meantime, you had another one here. You'll notice as well, you hit that trade. So there's 500 points. Happy days. Had a quite good month so far. And you get the idea. So you would have had this trade here. You would have shorted it. Put the stop above this swing. 2-to-1. Same on this one here. You would have got in probably down there. Swing above there. You would have, well, either been stopped out, or if you had the stomach for it, you could still have actually done quite well in this trade. And it just shows you how you can use the crossing strategy to make your trades and get in and out, providing that you're using protective stop loss on every trade and then getting 2-to-1 return on your money. That's the golden second rule. The first one is trade the direction of the trend. The second one is always get more from your winning trades than you're going to gain from your trades that lose, and hit your stop loss. Okay, so in summary, that is a very basic trend crossing or moving average crossing strategy. So some examples of moving average settings. So we had a look at a 50 period moving average, a 20 period. Was there any reason for that? Not really, other than they're simple rounded numbers and they're common numbers that traders use and electronic systems tend to use as well. There are other examples. I guess these are some of the common ones here. So 10, 20, 50, 100, 200. They're all pretty common. Other examples would be using the Fibonacci sequence of numbers. So these are numbers that a trader likes to use which are derived from the Fibonacci sequence. Maybe you could use as low as 5, probably not much lower than that. 5, 8, 13, 21, 34, 55, 88. My maths is probably going to let me down here. Was it 130? I can't even think of what the next one is actually. 130, 143, 100, whatever it is. And it will just continue to move up from there. 130. I don't know what I'm thinking, trying to add this up. 140. I'm failing miserably. Anyway, you can work out what the next one's going to be. And you don't tend to really go much further than sort of 88. Okay. You might need to go and view a tutorial or something if you're not sure of how to apply your moving average to your charting platform yourself. But once you've figured that out, the rest of it should be pretty straightforward. Okay, 143 was the next one in the number. I don't know why it took me so long to work that out. I'm normally pretty good with numbers. Okay, and benefits and drawbacks then, so of the system. So we've just looked at these trades and we just figured, oh, it's too good to be true, right? It's really simple. We can get into all this, make all this money. We could bet at £10 a point and we'd be making millions in a weeks or months. And there are people that do that. But there are some drawbacks to using moving averages, and the simple fact is they're lagging indicators. So whilst this looks fantastic as an opportunity to get in and trade right there, the reason that that trade cross happened right there is because of that candle right here. And it was 20 periods of data later that it has pulled that line down. So as these candles are closing and forming right now, these lines here, these moving averages might change the way they look in like 10 or 15 candles time, because more data has come along to enable that line to shape. So you just have to be aware that those lines will change. They're not always going to look the way they do right now. One of the benefits of the exponential moving average over the simple moving average is that it does reduce some of the lag that occurs in these averages. The lagging effect can be reduced because the calculation applies a higher weighting to the most recent data. And you could argue that they're a more realistic trend indicator than the simple moving average, but just the mere suggestion of that to a purist will probably spark a debate. The benefit of using the moving average is simple. It's the most straightforward way of graphically showing the direction of a trend. You can use moving average in your trading in multiple ways. There's levels of support and resistance, determining trends, as you can see here, identifying entries and exits like we've determined there, and it's also used in various other indicators as well. So you'll see them in lots of different technical tools. So hopefully that's helped explain to you how you can use your moving average, how they're calculated, the different strategies that you can apply, and what you can actually do to make money in your trading. We've only really looked at one chart, but that same procedure would apply on other ones as well. And just to finish off, we're going to take a quick look at one other market, and then we'll leave you to do the rest on your charting platform. So let's take a look at the Euro USD. Again, we're going to just remove these, start blank. I have one other indicator on this charting platform normally, which is a fractal indicator. Ignore that for now. And we're just going to look at the moving averages. So I've got a daily chart. For simplicity, consistency, I'm going to apply a 200-day moving average, decide where we are. In this particular case, it's a bad example because we're oscillating around it. We've just crossed above. But we'll just go back a little bit here. Nice trade right here. Okay, so big trend. Really, really steep decline on the 200-day moving average. So you would only be looking to sell in this market. You would have been buying here because you were above. And you'd be definitely only selling here. So let's go into a 30-minute chart. And I'm going to just apply that 200-day moving average. Give me 1 second. Here we go. This was the data. It's been a bit laggy because I'm using a server. Wait for it to catch up with me. Doesn't really want to go out much further than that. Okay. So let's zoom in on that. Maybe take a bit more. Even a bit more. Okay. So we're below the 200 period moving average. So what we're going to do now is apply a 20. And wow, FML. Give me 1 second. Let's go and do it again. And a 50 period as well. Okay, and we're going to just zoom into that because I'm getting annoyed of scrolling. Here we go. So we were in a bearish trend, so we were looking for selling opportunities. I've just zoomed into this particular area here. And a couple of opportunities that pierced straight up. There's one there. There was one there. And one there. So 3 selling opportunities right there. One there as well, if you could see it. in fact even one there, but it would have probably not won. So that's how you would use your crossing system. You would just be saying to yourself, I'm below the 200 period moving average, I only want sell signals, there's my selling signal, and you would be basing your entries on the cross and your exits on either a profit target or a stop loss, protective stop loss. So a bit of a crude example, but it just goes to show you can apply it to any markets, and you can really put it on anything. So gold, oil, forex pairs, stock markets, commodities of general. It's all easy enough to apply for you. So best of luck with all of your trading, guys. Send us a message if you need any help with this. There'll be various electronic trading systems available on the website that will allow you to trade these particular strategies automatically and apply the indicators on your charts that will give you signals if you're at work, for example, and you want to trade using your phone or your tablet. Have a look at following some of the links at the bottom of the video if you're interested in purchasing those for yourself. But best of luck trading, and we'll see you in the live webinars.